Hey there, welcome to the wonderful, sometimes confusing world of the stock market. Today, we're going to cover the most important stock market terms, the ones that really matter. But don't worry, we'll keep it simple and fun. Meet Stickman, our fearless explorer through the land of stocks. By the end of this video, you'll understand what the pros know and maybe even impress your friends at dinner with stock market lingo. Before we jump in, a quick disclaimer. I am not giving financial advice. I'm just your guide, your narrator, your friendly Stickman cheerleader through this maze. Now, let's get started. First things first, what is a stock? A stock represents ownership in a company, like owning a tiny slice of a pizza. But the pizza can grow, shrink, or sometimes disappear. There are two main types, common and preferred. Common stock is what most people buy. You get a claim on profits and a vote on big decisions, but dividends aren't guaranteed. Preferred stock? No votes usually, but dividends are steadier, and you get priority if the company shares money with investors. Most investors don't stop at one slice. They build a whole portfolio, a mix of investments. Some stocks pay dividends, basically a thank you check from the company's profits. Public companies list their stocks on an exchange. Anyone can buy. Private companies? Not so much. Their shares are usually with founders or private investors. And remember, owning stocks is exciting. But Stickman's face is priceless when prices fluctuate. The stock market is basically a big marketplace. But instead of fruit or clothes, people buy and sell ownership in companies. When you hear the market is up, it means most stocks are rising in price. When it's down, well, Stickman's portfolio probably looks like a sad roller coaster. In reality, the stock market isn't one single place. It's a network of exchanges where buying and selling happens. Two of the biggest ones? The New York Stock Exchange, NYSE, and NASDAQ. The NYSE is like an old-school auction house, full of suits, screens, and shouting. NASDAQ, on the other hand, is fully digital, fast, sleek, and home to tech giants like Apple and Microsoft. Prices move based on supply and demand. When more people want a stock, the price rises. When they rush to sell, it drops. That's why markets move constantly. They reflect emotion as much as logic. As Stickman learns, the stock market runs not on fuel, but on FOMO and panic. To make sense of all this chaos, investors use something called an index, a group of selected stocks that represents a piece of the market. Think of it like a report card showing how that part of the market is doing. For example, the S&P 500 tracks 500 of the biggest US companies. The Dow Jones Industrial Average focuses on just 30 major ones, the old, established players. And the NASDAQ Composite? That's the tech-heavy one. Fast, volatile, full of excitement. Indexes act as benchmarks, a way to measure your portfolio's performance. If Stickman's investments go up 5%, but the S&P 500 goes up 10%, he didn't really beat the market. Even if he's dancing around thinking he did. Indexes also help fund managers and ETFs know what to track. So next time you hear, the market is down, what they really mean is, the index is down. The most famous animals in finance. When prices are rising and investors are confident, we call it a bull market. The bull charges forward, horns up, full of optimism. When prices fall and fear takes over, it's a bear market. The bear swipes down with its claws, pulling prices lower. Stickman once tried to fight the bear. Let's just say, the bear won. But here's the truth. Markets move in cycles. They rise, fall, recover, and repeat. It's totally normal. A bull market might last years. A bear market could last months. Smart investors prepare for both, instead of panicking every time prices drop. Volatility, those sharp ups and downs, is part of the ride. So if you ever see Stickman holding onto a rocket one day and an umbrella the next, he's just experiencing what every investor does, the emotional roller coaster of the market. Now, not all companies are open for everyone to invest in. A public company lists its shares on a stock exchange. That means anyone, even Stickman, can buy a piece of it. Think of companies like Apple, Coca-Cola, or Tesla. You can literally own a tiny part of them just by buying one share. A private company, though, keeps its ownership behind closed doors. Their shares are held by founders, employees, or private investors. Stickman once tried sneaking into a private company meeting, only to get caught by security. Going public, called an IPO, or initial public offering, is when a company sells its stock to the public for the first time. It's a big moment, lights, headlines, confetti. But it also means more rules, more transparency, and more people watching your every move. The stock market isn't just made up of companies and investors. It's a busy ecosystem, full of different players. There are retail investors, like Stickman, individuals buying small amounts. Then institutional investors, big players like banks, pension funds, and mutual funds. They trade in massive volumes and can move the market with a single decision. And let's not forget brokers, the middlemen connecting buyers and sellers. Once upon a time, Stickman had to call his broker to trade. Now, a few taps on his phone and boom, instant buy or sell. There are also market makers who provide liquidity so trades can happen smoothly. And regulators, the SEC, or Securities and Exchange Commission, the referees making sure no one cheats. Without them, the market would be a wild west of chaos, and Stickman would definitely get scammed at least twice a week. When you buy or sell a stock, it happens through an order. There are two main types: a market order, which buys or sells instantly at the current price; a limit order, which waits until your desired price is reached. The difference? Speed versus control. Stickman likes control, but somehow always sets his limit just a bit too low. Stocks are identified by their ticker symbols, short codes like AAPL for Apple or TSLA for Tesla. And prices are influenced by volume, how many shares are traded, and liquidity, or how easily they can be bought or sold. Every trade happens on an exchange, through bid and ask prices, what buyers want to pay and what sellers want to get. The gap between them? That's called the spread. Stickman once tried to negotiate the spread, with no success. When a company earns profit, it can do two things: reinvest it to grow or share part of it with shareholders. That shared part is a dividend, basically a thank you note with money attached. Some companies pay dividends regularly, others keep all profits for expansion. Another key term is earnings per share, EPS, how much profit the company makes per share. Higher EPS often means a stronger company, unless they got there through creative accounting. Stickman once tried to calculate EPS manually, using a napkin and a pen. It didn't go well. Investors watch earnings reports every quarter. These can move markets fast. If a company beats expectations, the stock can jump. Miss them, and prices drop like Stickman's jaw at his first tax bill. Dividends and earnings tell the story of how healthy a company really is. So understanding them helps you separate strong businesses from the ones just pretending to be. Now that Stickman knows what stocks are, it's time to learn how to tell if one's worth it. That's where valuation ratios come in. Basically, the math behind the madness. The first one is the P/E ratio, price to earnings. It shows how much investors are paying for each dollar of earnings. A high PE? It could mean the stock's overpriced, or that investors expect big growth. A low PE? Maybe it's a bargain, or a warning sign. Stickman once bought a low PE stock thinking it was cheap. Turns out, it was cheap for a reason. Then we have the P/B ratio, price to book value, comparing a company's market price to what its assets are worth on paper. It's like checking if the sticker price matches what's under the hood. And the dividend yield, that's how much income you earn from dividends compared to the stock's price. Stickman likes to call it his snack ratio. Low yield equals light snack. High yield equals steak dinner. Unless the company's in trouble, then it's just your last meal. Now that Stickman understands valuation, it's time to talk about market capitalization, or market cap for short. It's simply the stock price multiplied by the number of shares a company has. Big companies like Apple, huge market cap, skyscrapers in the stock world. Small companies, tiny coffee shops, fun, but one bad review can shake them. Investors often group companies into large cap, mid cap, and small cap. Large caps are stable and safe. Mid caps are the steady growers. Small caps? Wild rides with big dreams. Stickman once filled his portfolio with only small caps, hoping for rocket growth. It launched all right, straight down. Knowing market cap helps Stickman balance his portfolio between giants that grow slow and little ones that might just surprise him. Next up, volatility, the market's mood swings. It shows how wildly prices move up and down. Some days it's calm, other days it's pure chaos. Tech stocks? Usually roller coasters. Utilities? More like lazy rivers. Stickman once thought he could handle the ups and downs, until he saw his portfolio doing gymnastics. That's volatility in action. Traders even track something called the VIX, often nicknamed the fear index. When it's high, everyone's nervous. When it's low, everyone's chill. Understanding volatility helps Stickman keep his cool. No panic selling, no overconfidence, just strategy. Because in the stock market, emotional control can be more valuable than the stock itself. If volatility is the roller coaster, diversification is Stickman's seatbelt. It means spreading your money across different companies, sectors, or assets, so one bad move doesn't ruin your day. Your collection of investments? That's your portfolio. Some investors mix stocks, bonds, ETFs, even gold. Others go all in on one sector and pray. Stickman once bet everything on a single tech stock. It crashed. Now he knows even the best idea needs a backup plan. A diversified portfolio helps smooth out the ups and downs. When one stock falls, another might rise, keeping your overall balance steady. It's not just smart, it's survival. Diversification keeps Stickman's portfolio alive and his heart rate normal. Some investors love picking individual stocks. Stickman tried that once and aged 5 years in 1 week. Then he discovered index funds and ETFs, the chill way to invest. Instead of buying one company, you buy a tiny piece of many. An index fund tracks a benchmark like the S&P 500, giving you exposure to hundreds of companies in one go. ETFs do the same but can be traded anytime, like a regular stock. They're simple, diversified, and low cost, perfect for long-term investors who don't want the stress of daily trading. Stickman calls it lazy genius investing. He just sets it, forgets it, and lets the market do the heavy lifting, while he enjoys his coffee instead of checking charts every 5 minutes. Finally, let's talk extremes. Blue chip and penny stocks. Blue chip stocks are the big, established companies. Think Coca-Cola, Apple, or Johnson & Johnson. They've been around forever, pay reliable dividends, and don't give Stickman a heart attack when he checks his portfolio. Penny stocks, on the other hand, are the Wild West. Tiny companies with cheap shares and big promises. Sure, some might skyrocket, but most fizzle out faster than Stickman's morning coffee. He once bought a handful, dreaming of instant wealth. Now, he calls them lottery tickets in disguise. Blue chips bring stability. Penny stocks bring excitement. And Stickman? He's learning to balance both. Because smart investing means knowing when to play safe and when to take a tiny risk. Every investment comes with risk. No risk, no reward. That's the rule. But too much risk? Stickman calls that financial cliff diving. He once chased the hottest stock of the month. It looked unstoppable until it stopped. Now he knows. Higher potential rewards usually come with higher chances of pain. That's why patience matters. The market rewards those who stay calm when others panic. Stickman used to check prices every hour. Now he checks once a month and sleeps much better. Because in the long run, the biggest edge isn't timing the market, it's time in the market. Stickman finally learned. Investing isn't a sprint. It's a marathon with a few scary hills. And that's a wrap for Stickman's investing journey, from wild volatility to chill diversification. He's learned that index funds can save your nerves and penny stocks can test your luck. Whether it's blue chips, ETFs, or just keeping emotions in check, it all comes down to balance and patience. If you found this video helpful, give it a thumbs up, subscribe for more simple, visual finance lessons, and let us know in the comments which stock market term finally clicked for you today. Thanks for watching, and remember, stay curious, stay patient, and don't let Stickman trade while he's emotional.